Okay, well, I guess I'll just kind of get started. So I want to welcome everyone to, as Andrea mentioned, the first of many OGAA speaker series. So my name is Janan and I graduated Elmwood in 2013. So for those who might not know, the OGAA is an alumni network with over 5,000 alum living coast to coast and around the globe. And what brings us all together is Elmwood, a place where friendships were formed, academic goals are achieved, athletic pursuits were encouraged, and potential was realized. So during my time at Elmwood, I was incredibly involved in various clubs such as Model UN, the Screen Team, Duke of Ed. I was able to go to OSA for basketball and rugby. And also while at Elmwood, I realized the importance of volunteering and learning about various causes that I still continue to be involved in today, including women empowerment and gender equality. So right now in my day-to-day, I currently am a product marketing specialist at Top Hat, which is an education technology company that seeks to essentially disrupt higher education. So we're super excited to launch this new initiative, which gives the opportunity for current Elmwood students and alums to have conversations around topics that are relevant, current, and insightful. So the core of today's event, entitled Banking 101, is about financial literacy, the ability to understand and effectively use various financial skills. So I'll admit, finance, even the word alone, was super terrifying to me when I was younger, and even today. I didn't understand many aspects of it, and in many ways was scared to ask for guidance. So as I've gotten older, I've realized how financial literacy is first and foremost a lifelong journey of learning. So financial management, budgeting, and investing takes time to master, but the earlier you start, the better off you will be in the long run. So as with everyone in attendance today, I look forward to continuing to learn more and applying this knowledge to my daily life. So to begin, I want to introduce Suzanne Robertson, who will be running today's session. Suzanne received her honors bachelor's degree in economics with a concentration in finance from Carleton University. She has been working in the finance industry for over 15 years with experience in wealth management, lending, and retail banking. Currently, she is the manager at the Bank of Montreal, Beechwood and Mackay branch in Ottawa. In her spare time, she can be found training for marathons. So feel free to post questions in the chat, but there will also be time for a Q&A. So at this point, I'll hand it over to you, Suzanne.
Excellent. Thank you very much, Janan. And first and foremost, I would just like to begin by acknowledging the land, even though we're not physically present in land, that we are gathering in the traditional unceded territory of the Algonquin Anishinaabe people. The Algonquin peoples have lived on this land since the immemorial, and we are grateful to be on their territory. So also thank you so much, Andrea and Janan, and to the OGAA group, everybody who is on this call tonight. I do appreciate you guys inviting me to be your very first speaker. And banking isn't something that seems so exciting to learn about or listen to, but these little basics that I'm gonna help you guys learn about this evening, I do hope you take something away from tonight's session. And as well, this, exactly as Janan was saying, the sooner you start to develop an understanding of finance and banking, the further ahead you will be in the future. So, and Janan, whenever you want to switch to the next slide, please, that would be great. So I'm going to cover three primary areas this evening. One is bank accounts, the different types of accounts that we have, basic checking and savings accounts, and the benefits to having both of the accounts. Big part that a lot of people should start to learn about at a younger age, because it's going to put you that much further ahead when you are in your late teens, early 20s, 30s, 40s, 50s, 60s, 70s, through to 100 years, is understanding credit, how you can build it, what credit means, what are the 5 C's of credit. So this is something that I'm going to go over with you all tonight. And last but not least, now with technology and more banking being done online and finance being done online and no longer in person, we still have in person, obviously, my job, but online security is a huge piece of protecting not only your finances, but also your personal information. And all too easily, we do see people get scammed, unfortunately. So I'm going to provide you some tips and tricks on how to avoid falling for these potential scams, as well as protecting your online security for your banking information and doing everything that you can to try and make certain that no one accesses your information, tries to obtain your information, or tries to impersonate you, because this can happen. And we'll go to the next slide, please. All right. So when it comes to banking, there's basically two types of simple accounts that you can have. There's a checking account and a savings account. Some people don't realize the difference between the two. And to start, first and foremost, a checking account is what you use for your day-to-day. It's where you should put your money for the short term. The benefits to having a checking account, it's meant for daily transactions. So for example, if you like to go get your coffee every morning at Starbucks or in the afternoon, you would use your checking account for that. Buying groceries, going shopping, you have your debit card, which is linked to your checking account, and that's what you would use it for. Now, one thing I will mention here is that a lot of people think that your debit card is your checking account, but it's not. It's simply linked to your account. So if someone obtained your debit card, they found it on the ground, it doesn't mean that they have your account, they instantly have access to your account. They're actually separate things, just so you guys understand that. Funds are easily accessible with a debit card from your checking account. As we know now, you can tap to pay, or you have a 4-digit PIN that you would use with your debit card. Checking accounts also allow you to pay bills and send money securely. For example, having a checking account would allow you to send an email money transfer to your friend if perhaps you borrowed $20 from her. Easier way to pay it back versus handling physical cash. Over the pandemic, more and more stores, restaurants, businesses, it's become more of a cashless society in North America and in Canada. And we're going to continue to see more of that. So having a checking account and having a debit card will make your life easier. One thing to note about checking accounts is that regardless of which bank you're with, there's different type of checking account bank plans is what they are. So for example, if you're a student, you would probably have a student checking account, and that would be free. Or if you're a teen as well, you would have access to free banking, but that would give you a limited number of transactions. Quite often student accounts, if you want the free student account, you'll get about 25 transactions per month. What is a transaction? Anytime you use your debit card to purchase or do a cash withdrawal out of the account, that is what is considered a transaction. So if you use your card once a day, or maybe every other day, then 25 transactions per month should be enough for you. You may not even use your debit card that often, so then you wouldn't pay any fees. If you do use your card more than 25 times a month, or whatever the limit is on your bank plan, the features that it offers, you may incur additional fees. And this is something where I see a lot of young adults and teens be impacted by, because they don't realize that if you go over the set number of transactions that you are allowed, each additional transaction you do is $1.25 typically, or at least $1. And this can add up very quickly if you are using your debit card 2, 3, 4 times a day. At the end of the month, you should always look at your transaction history on your account, whether you look at it online, through your mobile banking app, or if you like to be traditional and you still want to receive a paper statement in the mail, you can also receive that. But the important thing is to make certain that you are aware of how much you're paying in fees, because banks are always there to help you minimize those fees. It's not that we want to charge you because they're greedy. It's no, we want to help you save money. And that's where having this piece of knowledge We'll help you. We want you to keep your money to be yours. We don't need it. We don't want it. I want you guys to have the money. So always look at your transaction fees at the end of each month. And if you think something doesn't seem right, call your bank, message them online, call your local branch. If you have a financial advisor you already work with, call them. We're here to help. So those are the basics for checking accounts for you. So again, primary checking accounts meant for your day-to-day transactions. Short-term, where you park your funds because you're going to use it sooner than later. And easily accessible, linked to a debit card, can do online payments, email money transfers. Checking accounts make your life simpler. And also, if you have a job or if you get your first time job, you will need a checking account because you'll likely be paid by direct deposit from your employer. So they will need your banking information. Or if your employer writes you a check, the check will be made payable to you and it must be deposited into an account that's in your name. It cannot be deposited to someone else's account, whether it's your brother's, your sister's, your mother's, your father's. It needs to be deposited into account for you. So benefits to the checking account. A savings account is a bit different because it's meant to be long-term in that you're setting your money aside and you're saving for something, hence the name savings account. Let's say there was a bike that you wanted to buy, or you're saving for college or university tuition, or your housing expenses when you first moved out. This is what savings accounts are good for, to set for specific goals or to have money set aside for emergencies. By emergencies, of course, I mean, what if your car broke down and you had to get a quick oil change, anything, right? Like you may need to have to access these funds from the savings account because you've already spent all the money in your checking account. Always good to have an emergency fund available to you. The benefits to having a savings account: A, you're setting aside money for your long-term goals, maybe your dream vacation, again, tuition, buying a house. This is what it's here to help you for. You can earn interest, which is earning money on your money, which is one of the best ways you can do it because money makes money. Truthfully, that's what it comes down to. And it can help you achieve your longer-term financial goals. And as well, by earning interest, you may start to see it over the month. And you're like, oh, hey, I earned an extra $20 by having that $100 sitting there. Those aren't realistic numbers this day and age with interest rates, but just to give you an idea for illustrative purposes. And certain savings accounts, you are allowed to do maybe 1 or 2 withdrawals per month without incurring a fee. But the savings account is not meant to be used like your checking account. It is not your day-to-day account, because if you start using your savings account for all of your shopping or spending with your debit card, you will incur fees. So the way I look at it, checking, easily accessible. You can use it all day, every day. Savings account, I like to say, set it and forget it. Don't use it until you need to use it. So next slide, please. All right. So as we were saying, it is beneficial to actually have both of the accounts. Primary reason for that, it will help you manage your spending. For example, if you received a paycheck of $500, it's always good to set some money from your pay aside to help you accumulate that savings fund. The general rule of thumb is save 10% of your paycheck. So if you have $500 deposited to your checking account, move $50 over into your savings account. And that way you kind of forget about it. And because it's not sitting in your checking account, you're less likely to spend it. So this is going to help you reach your financial goals in the long term, or maybe even in the short term. And it also offers different ways to bank. You're not just limited to having a single checking account or a single savings account. You can have both. And that's going to give you more flexibility when it comes to budgeting, which I will get into shortly, and helping you achieve your financial goals. So actually, I'll go back to budgeting before I jump on that one. I forgot the next slide jumped into credit. I apologize. Now, what is budgeting? It's a question that I do get asked frequently in my job, as well as my employees do. And it's something it's honestly simple math. Don't make budgeting a complicated thing. Basically, what it is, budgeting is you need to figure out your income. And your income is what you make, your take-home pay. And there's a few different sources where you can have your income from. It could be from part-time work or full-time work, your job, your summer job. It could be from your investments. So if you did earn money in your savings account, the interest income, that's an income. It could be family income. For example, if your parents give you a monthly allowance or a weekly allowance, I don't know if that's still a thing or not this day and age. It was back in my day. We'd have to do chores and I'd get, $20 a week or something. But this is your source of income, and as well, birthday gifts. Who doesn't love getting cash as a birthday present or a Christmas present? Because then you can go out and buy what you want. That is your source of income. So you have that. That's the way you've earned your income. It's sitting in your checking account. But then how do you budget? Well, the other component of your budget is your expenses. And there's two types of expenses you can have. You can have fixed expenses and variable expenses. The difference between the two is that fixed is something that each month you're going to have to pay. To keep it simple, that could be your cell phone, maybe locked in at a fixed rate where you pay exactly $55 a month. So right there, you're going to have to take that expense out of your income that you have for the month, as well as maybe your Apple TV subscription, $9.99 a month coming out of your account. You're going to have to set that aside. That's going to take away from your income. And then you have your variable expenses. And those are things that can change from month to month. They're never going to be the same cost. It could be you're spending on groceries, cosmetics, your car, fuel, buying your coffees, clothing. This is the amount of money that you choose to spend is your variable. Biggest thing, after you have your income and you have your expenses, you need to stop and look. You take your income minus your total expenses, and then that gives you your overall budget or what you've had for the month and what you would have remaining in savings. Ideally, income minus expenses is going to be a positive number. That way, at the end of each month, you can put some of that money into your savings account. If your expenses are greater than your income, meaning you've spent more than what you have, that will put you in a deficit. And that's where it is really important to budget and to make certain that you are not going into the negative each month, but that you're actually on track to have some savings to put into your savings account at the end of the month. So, key thing, you always want it to be a positive number. You always want it to have a little bit left at the end of the month. And that way you can help save for your future, your bigger goals, your tuition, etc. There you go. So after you've looked at your budget, you may end up in a situation in the future where you are running negative. And this is where building your credit can actually help you out. So next part is I'm going to talk about how to build your credit, what credit is, understanding your credit score, and the 5 C's of credit. So I'll get you to go to the next slide, please, Andrea, or Janan, whoever. Thank you. So what does it mean to build credit? And what is credit? As we all know, now you can have a credit card. Now, one of the things is that not everybody has a credit card. And part of the reason is some people just choose to not have credit and do not like using credit products because they may not want to spend more than what they have. And that is completely understandable. Also helps people stay in their budget more. But there are absolute benefits to establishing a credit history, because this is what's going to help you in the future if you need to apply for a mortgage when you're buying a home, if you're looking to obtain a student loan in just your own name, if you were to decide to go on to do a master's or a PhD, your parents may not financially help you with that. They may ask you that you pay it on your own. So building your credit at a younger age will help you when you do need to borrow at a future time. So credit is a way of borrowing money from lenders such as banks. So in return for borrowing this credit, you end up paying interest on it. There are different ways that you can manage your debt and by having credit. And there's also different types of credit products. I'm not going to go into big detail about that, but the most common one, and usually the very first credit product that you will ever get in your name, will be a credit card. So the way a credit card works is, for example, let's say you have $1,000 limit on that credit card. So that means that you can make purchases and spend up to $1,000 using this card. And then you are given a grace period where you do not have to pay any interest on the amount that you've borrowed, the $1,000. But if you do not make the payment of the $1,000 back in full by the due date for the credit card on your monthly statement, then the bank will charge you interest on that. That's how the banks make money. And this is how you're paying back for borrowing the credit. Interest rates on credit cards are quite high, and they're usually around 21%. So biggest piece of advice I would give you is do not spend what you do not have. Use your credit card because that is what helps you build credit history. But if you have $1,000 limit on your card and you only have $300 sitting in your bank account at the end of the month, and you've spent $1,000 on your card, you're going to be paying interest on the additional funds that you do not pay back of that $1,000. So the whole point of obtaining the credit card is that you're working on showing that you can manage your debt obligations. And the benefit to this is that it helps you to build your credit history. And this is what will help lenders determine, i.e. banks, whether or not you are worthy of them lending you money in the future to help you out with your financial position. So if you have a credit card, you don't pay it back in full, you end up not making any payments at all, this is going to impact what we call your credit worthiness. And the bank would be less likely to loan you money in the future, or if they do, it is going to be at a higher interest rate. The higher the interest rate is based upon what your credit history is like, what your ability is to manage your debt, and the likelihood that the bank thinks you will pay it back. So this is why I say it's important to start this early at a younger age, because the sooner you start to establish your own personal credit bureau, the easier it is going to be in the future for you to borrow when you may need a car loan or a mortgage or a student line of credit to help pay in the future. So the better your credit history is, the more likely you are to qualify for loans and not need a co-signer. And a co-signer is a parent or a friend who has income, who may have a better credit history, and they may have to sign on the loan with you. Ideally, you want to create your own financial position where it's strong enough where you would be able to qualify for that loan on yourself, by yourself. And we'll go to the next slide, please. So building credit, kind of already mentioned, how do you do it and why it's important? The banks and lenders have something called the 5 C's of credit. They all kind of intermingle to be the same kind of thing. But when we as lenders are looking at A, do you have a credit history? And B, if you don't, do we think you're worthy of actually loaning you money? The 5 C's are what we are looking at. So the first C is capacity. And this determines whether or not you can repay based on your income, your employment, your current employment, as well as your employment history. And what we mean by that is, do you make a good income? Are you a salaried based employee? Like, for example, do you work full-time for the government and you know every month you're taking home $5,000 and you have that year over year? That's what we look at. It's your income stability, your employment stability. If you are new to your job, and if you're still on your 3-month probation history, that's a greater risk. The bank may be less likely to loan to you until a few months after you've passed your probation period. And employment history as well. Are you someone who jumps from job to job and you change your job maybe twice a year? That can be a red flag, because we like to see employment stability and income stability. Character. This evaluates your track record of making payments and how you manage your credit. And I'm sure we'll have some questions about this a little bit later. Character is a huge piece when it comes to making your payments. I'm not going to get in detail about that now, because I expect I'll have a question about that later. But like I said previously, is you want to make certain that you're always making a payment when it's by the due date, and that you're not missing any payments or late on your payments. When you are late on your payments, this impacts your credit score. And the history of missed or late payments shows up on your credit bureau. The lower your credit score is, the less likely a lender is to lend to you in the future. Collateral is the pledge of a certain asset for a loan. So a collateral is a security against what we are going to loan you. For example, the most common type of collateral that someone would put up would be their house. When you are looking to buy a house, most likely you will have to take out a mortgage to purchase that home, because you probably do not have $700,000 readily available sitting in your checking account to buy the home outright. Nor is that a good use by putting all of your funds into the home right off the bat, because you may need some of your cash and funds in the future to do renovations on the home, or to buy a new car, or to help pay for your kids' tuition, etc. So you will likely be obtaining a mortgage at some point in your life. So your home is your collateral against the loan. Or a car is also, if you're buying a new car, you may need to obtain a loan on that. That is also collateral against the loan. And the last C is capital. So this is your overall amount of investments and assets that you have, such as the cash in your bank account, like your checking account, your savings account, cash that you may have in another investment vehicle if you own stocks, or GICs, guaranteed investment certificates. Or maybe you already own a home with no loan on it. That would be part of your capital. Or you own land, as well as your car. These are all pieces of your capital. So it's these 5 C's together that the bank would use to help determine your credit worthiness. And as long as you have a good grasp on these, it's going to help you have a better credit score in the future when you do need to go buy a big loan. So we'll get to the next slide. So building credit, again, your credit scores. In Canada, we have 2 credit bureaus that are used by the banks and by financial institutions and lenders. One is called Equifax, and the other one is called TransUnion. So this example that I use here is someone, this is their TransUnion credit score. The perfect credit score is 900. Truthfully, almost no one is ever at 900. It's very rarely you actually see somebody between the 800 and 900 range. Your average consumer will usually be, as you can see from the numbers, between around 740 up to about 830. This person here has a score of 797. So they're between, about that is also known as to be an excellent credit score. It's a very good credit score. Someone with a credit score like this has likely managed his or her finances very well. They've always made, at the very least, the minimum payments that were due on their credit bills, probably have good income stability, good employment as well too. But your credit score is really your ability to repay and what your payment history has been like. So someone with 797 would come into a bank and he or she would probably be qualified for a type of the type of loan that they were looking for, as long as they had good employment as well as a good income to support the loan too. You never want to have your credit score drop below 700, because then that puts you in the lower and it starts to become a red flag area where lenders are less likely to lend to you, or they will lend to you, but it will be at a higher interest rate. So always try and keep your credit score in between above 700 and up to about 850. If you fall in that area, then you will be good when it comes to the future. Okay, you go to the next slide, please. So how can you build credit? So apply for a credit card. Credit cards will be the very first credit product that you will likely obtain or you have obtained in the past. And it helps you build your credit score. You always have a maximum credit limit. As my example said, if the limit on the card is $1,000, the most you can spend on it is $1,000. In the province of Ontario, you must be 18 years of age to apply for a credit card. What we do recommend when you're a student, often when you go off to university, you'll be 17, turning 18. Almost all banks and lenders do offer student credit cards with lower spending limits. Typically, they're around $500 to $1,000. Generally, never higher than a $2,000 card limit. Key to building this credit score is making your payments on time. So make sure your monthly credit card payments are paid by the due date. One thing I will say here is if you use your credit card to buy something at Walmart, let's say for $50, and the same day you decided to turn around and pay off that, like instantly transfer the money from your checking account to pay off what you just charged on your credit card, that is not recommended, because by doing that, it does not actually help you to build your own credit score and establish a credit history, because the balance that you charged on your card has not sat there long enough to show up on your credit report. So don't pay it back as soon as you've charged it, but just make certain that you always pay it by the due date on your bill. At the very least, if you were in a month where maybe you had greater than normal expenses, if you cannot pay the balance in full, at the very least, you must make the minimum payment. Making only the minimum won't negatively impact your credit score if you do it from time to time. Missing the payment or having a late payment is what impacts your credit score. So limit the number of credit applications that you have as well too. Each credit application will show as an inquiry on your credit bureau. That's with Equifax or TransUnion. The more that you have, this will negatively impact your credit score. And lenders may then interpret you as a credit seeker, meaning you're just trying to get access to cash from almost any place you can. So that can be seen as being a risk. And have an extensive credit history. So this is why I do recommend that you consider opening a credit card when you do turn 18 years of age, because you've started younger. So then even by the time you're 23, 25, or 30, you're already going to have a longer history of a credit bureau. And the longer your credit bureau is showing that it's been in good standing, lenders are more likely to lend to you. Go to the next slide, please. So the last section I wanted to talk about tonight is online security. And I think this is very important because there's different types. There's phishing and there's malware, but also these scammers are very good. In the pandemic, online financial fraud, client impersonation, account takeovers where people have hacked your online banking account. This has hit an all-time high. And unfortunately, these scammers are getting better as time goes on. So I don't think this is not going away anytime soon. These people are professionals. So I want to give you some tips on how you can protect yourself. So online, there's two types really. There's phishing, and it's the most common type of cybercrime. What this is a scammer may send you an email that looks like it came from a legitimate source. For example, you may receive an email from something that looks like it was from Amazon, and they're advising you that, oh, you need to click here, there's a problem with your order. But in actual fact, by clicking the link in this email, you have then given these scammers access to your computer so that they now are on your computer. And then quite often too, they'll ask you to input your banking information, like your debit card number, as well as the expiration date on your debit card and the customer verification code that's on the back of your card. Once the scammers have those three pieces of information, they can then start doing online purchases using your bank account, essentially. So, and they also want to have you enter these links too, because that way they may obtain your password to your online banking, or they can just get little pieces of information from you. And that is why it's called phishing. It's like they reel it out there. They want to see what they can get from you, and then they're going to use your information for their financial benefit. And malware. So malware is a program or file that intentionally causes harm to your computer or cell phone or other electronic devices such as your tablets. They use malware that's been input onto your computer to steal your information, as well as gaining access to your passwords. We'll go to the next slide, please. So job scams. This is where we've seen some of the primary fraud committed during the pandemic. Job scams are always something that seems too good to be true. And often these job scammers, it will look like a real job, and they may have a posting on LinkedIn, or I think Indeed is one of the other programs that they use. And it seems like, oh my gosh, this is my dream job. I want it. Quite often they will target a younger, more vulnerable population. And they do this because they think you're easier to scam, you're more likely to fall for it. You think, oh great, my very first job and I'm getting paid $3,000 for the very first week. I mean, if that were the case, then I wouldn't be working in banking. I too would probably want to work for that person. It's too good to be true. So if you ever see a job posting where they're offering to pay you up front, and you get the job too easily, there's no interview, there's no real background check. They may ask you for you to send in a piece of photo ID, such as your passport or your driver's license. They'll ask to obtain your social insurance number. Then right there, they have two big pieces of information from you. You look up the company, you can't find much about it. But yet they're going ahead and paying you even before you've started the job. The two most common scams that we see for this is what I call the nanny scam, where they ask you, oh yeah, come be my nanny for the summer while you're off school. Look after my 3 kids. We're moving to the city. I'm going to pay you $3,000 up front. I want you to go to the bank, cash this check that I've given you, take out the cash, and then go buy some groceries for us. For that way, when we're arrived to the house, there's going to be a person that you're going to give $2,500 to, and the remaining money you can keep for yourself for your trouble. And that's a common one. Or the tour guide scam, where they're saying, oh, you're going to be a tour guide in the city of Ottawa. Here's $5,000 to begin with. Go buy X, Y, and Z. And then they'll ask you to send money back to them by email money transfer, or often they'll ask for you go to buy American dollars with this money, or they'll ask you to send it back via cryptocurrency. Number one thing I can say is that if you ever have a job where they say, oh, send us money via cryptocurrency, that is most likely 100% a scam. If it seems too good to be true, don't fall for it. And then there's also other ones too, where there's what they kind of call like an advanced fee scam. And I see this happen to younger people very often, but I also see it to happen to people my age, in their 50s, 60s, 70s, 20s, doesn't matter. Where if you post a product online for sale, say you're looking to sell your old winter coat because it doesn't do anything for you anymore, you post it on Facebook Marketplace for $200, and then someone says, oh, actually, I'll pay you $500 for it. And they'll send you an email money transfer for that. First of all, why are they paying more than double what you're asking for this? And the other thing too is you don't know who this person is that's going to send you this email money transfer. And quite often you'll be the recipient of this email money transfer, and it turns out it was fraudulent funds. And you need to protect yourself from email money transfers when you do not, first of all, if they're sending you more than they should, or if you don't know who the buyer is, you need to treat them like cash. Because if someone sends you a fraudulent email money transfers are based off the Interact system. This is the same system used amongst all banks in Canada. So if you receive fraudulent funds, it's not that you no longer have access to email money transfers at the bank you're dealing with. It blocks you from Interact transfers from all banks because it's the Interact system. It's not bank specific. And then the person who sent you the fraudulent money, you will be on the hook for it. If you went ahead and spent it, you may be responsible for paying it back. So you really need to protect yourself when it comes to online email money transfers as well, especially when it comes to job scams or buying things online. Again, treat email money transfers like cash. If you do not know the sender of the email money transfer, or if you do not know the person who you're sending email money transfer to or who has asked you to do so, then don't do it. Only deal with people who you know and who you can trust. And next slide. So online security, the best practices. Never click links or download files and emails from unknown senders. If you receive an email with an attachment and you're not too sure, even if it looks like it came from a bank or from MasterCard or Visa, but it doesn't seem right, then just delete it or send it to whichever financial institution it may be. We all have an is it safe kind of email that you can send it to. Never provide personal information to anyone online who you do not know. Your banking information is very private and you need to protect it. If you receive a suspicious email from a friend, ask them about it, verify it from them, because it may have not have been your friend who sent it. They may have been hacked online. So, just give them a call and be like, hey, Joanne, did you actually send me this? And if Joanne's like, what are you talking about? Then okay. But if she's like, oh yeah, that was me. It was for buying those shoes for me or paying you back. That's good. Social media can actually be used for access your online banking passwords, even though you don't think about this. If you ever do those surveys or emails or Facebook posts where it talks about, oh, the name of my first pet, my favorite food, my favorite color, my favorite instrument. These are all banking password security questions, and you're providing the answers to these scammers directly online in the public, and they can use this to try and hack your information. So always make certain that you're protecting yourself when you think these are just for fun, because it may not be. It's a way of these scammers phishing. And use multi-factor authentication. So when you have your Facebook account or your Instagram account, link it to your cell phone as well too. That way they can do a two-factor authentication. And again, never share personal information online. And your passwords for your banking as well as your social media accounts or anything you do online, use strong passwords. They should always be at least 8 characters, should have letters, numbers, uppercase, lowercase, and symbols. Never write passwords down. You can get apps like a password keeper. They are very good because you need a master password to get into access to all of your other passwords. This is better security than you just putting it on your notepad on your phone or texting it to yourself or writing it on a piece of paper. Never put your passwords in writing on something like that. And avoid using personal information or easy to guess passwords or PIN numbers when it comes to your debit card as well too. You don't want to use the name. You don't want to use your middle name. You don't want to use your mother's name. You never ever use your date of birth, because those are numbers that are easily guessed by fraudsters if they have any of your information. We'll go to the next slide. I think that's pretty much it. So these are a few banking resources that kind of are the basics of banking 101, banking for students, understanding banking and understanding credit. These are all from the Government of Canada. They're not bank specific, but they're very general, and it will answer a lot of the questions that you may have, more detailed answers than what I've been able to provide tonight, because I'm just kind of doing a high level overview of everything. So be sure to check these out. Absolutely great sources on the Canadian Bankers Association website as well too. So thank you.
Awesome. Thanks, Suzanne. I do see a question that came in asking, how do you recommend that as we get older, we maintain good relationships with our bank managers? What should we be doing regularly?
This is a good question, and it can be hard as someone who works in the financial industry. It's not like it used to be where it was the same branch manager for 25 years. The reality is that people are fluid in their jobs now. We move to different roles consistently. But the key thing is go into your local branch. If you deal with a financial institution that does have a physical branch, I say that because Tangerine, Simply Financial, they don't unless you're in Toronto. But go in, just introduce yourself and just be like, I'd like to just introduce myself to the branch manager or to a financial advisor who works there, and be like, I haven't come in here. I kind of want to establish a relationship. Because if you find a good advisor or a good branch manager, he or she, or they will hand you off to someone when they are leaving. If they are leaving, they're going to get to know you. You're going to develop that rapport and that relationship with them. And that's really important when it comes to finance. And yes, they move on to a new role, but they're here to help you, advise and guide you. And they're going to make certain that you're taken care of. And if you get the feeling that, I don't think they're that kind of person, always go with your gut, because you're going to get the right vibe off that person and whether or not you think you'll work well with that person. But meeting in person, booking an appointment, that's the number one step to getting to know who your bankers or who your financial advisors are, and who you may want to work with.
I have one here as well about, so you say credit cards, the questions you can get a credit card at age 18. What about the ones that you're under your parents' credit card? Can you talk about those?
Yeah, absolutely. Great question. And I do see more of this now because almost anything that you want to buy online, you need to have a credit card for it. Or for example, a lot of us are iPhone users or Google users. So you have Google Pay, Apple Pay, or if you're signed up through your Xbox and you want to buy game add-ons or anything. Often you will need a credit card for this. They won't always take debit MasterCards or debit Visas. So a lot of parents will get a credit card, not in their son or daughter's name. They add an authorized user. So for example, I have a credit card, my 5-year-old, well, I shouldn't say 5, but let's say my 10-year-old is really into Xbox games, but they need a credit card linked up. I could get an additional credit card for him that maybe has a limit of only $500 max. And then he can use that. He's allowed to spend up to $500. It still all falls on me. I'm still the one paying it, but it doesn't build his credit history or his credit score because it's all still in my name. So you're just an authorized user. It doesn't actually help you to build your credit.
Another one, what can banks do if you've been scammed?
Good question. And I'd like to think that this doesn't happen, but we do deal with it daily. This is where it's important to log into your online banking on a regular basis. You don't have to log in daily, but at the very least, log into your online banking once a week. Few reasons for this. One, keeps your online banking account active. You're less likely to forget your password, which people always find very frustrating, resetting your passwords, myself included. But it's important to look at your transaction history, because you have 30 days to notify the bank or the credit card company of any charges that you disagree with. And this is the important thing to finding about it. If you see a charge that you disagree with, contact your bank immediately, whether you go in person or whether you do it over the phone with one of the bank's contact centers or the MasterCard Center or Visa Center. They'll do a fraud investigation for you to determine whether or not the transaction is actually fraudulent. And banks have a legal obligation to get back to you within 10 business days of you reporting the fraudulent transaction. If it has gone past 30 days, the bank may turn around and say, you have 30 days to report it. That's too bad. Unfortunately, they do work like that because it's important for you to take ownership as well on your bank account. Banks can't monitor everybody's transactions all the time, but banks are very good now with technology where we have algorithms where if we see suddenly there's a transaction done on your account down in California, but we've never seen you travel before, and you've never ever even been in the US, yet alone California, they'll usually block your card instantly. And it may be frustrating that they blocked your card because of that, but that's to help protect you and to make certain that you aren't at a potential greater loss. So 30 days is key. Be active with your online banking. Log in. Even if you don't like to log in online, you can call a bank representative. They'll help review your account with you.
Those were the questions I saw. Janan, did you catch any when you were looking through?
Oh, sorry, I realized I was on mute. No, I didn't. But I do have a question related to, I know you mentioned it earlier. I'm going to go back in the slide. I think it's a phishing tactic that I've realized recently where I think, I know I share a Netflix account, for example, with my parents. My parents have recently been getting messages from saying they're from Netflix, saying that you missed a payment or something like that. Have you been noticing that happen a lot with different apps that people have, where they'll get emails or text messages saying they missed a payment when that's not true at all?
Yeah, that's one of the most common is these scammers, like I was saying, they act as though they're messaging you from a bank or from a big corporation or Apple. And when you receive these emails, these phishing emails where they're trying to obtain your banking information, you can usually see red flags. Like if it says Apple at apple.com is the sender, it's probably not legit. If you see spelling mistakes or grammar mistakes in the email, that's always a red flag. And right off the bat, you can just say no. If it doesn't seem like you should be receiving it, just delete it. Because if it's an actual financial fraudulent transaction that did happen on your account, like I said, the banks or the credit card company will usually block your card. They are very good at detecting that it has been attempted to have been used elsewhere. And if you ever receive a text message too, saying, you have a pending email money transfer for $5,000, click here to receive it. Those are very common ones right now that we're seeing as well. No one's sending you money because they want to.
Yeah, I actually got one of those this weekend. Actually, I just hit delete because I was like, I don't recognize that name at all. Not one of my friends that owe me money. So I just hit delete quickly and forgot about it.
Exactly. If it seems too good to be true, it is.
And another question that came up, can you check your own credit rating?
Yes, you can.
Or is it something the banks need to do for you?
Nope, you can actually check it on your own now. It used to be difficult to do. Almost, I know Bank of Montreal, we do actually have it directly on our mobile app where you can get your credit score for free, no credit check. So it doesn't actually like hit your credit bureau like you're applying for a product. And it will tell you where your credit score is at that time. I'm certain that all of the major banks in Canada offer that as well now too. If you don't deal with a major bank, you can still, like if you dealt with Tangerine or somebody else, you can absolutely still get your credit score as well as your credit report by going to equifax.ca. I believe you fill out a form, email them, and they will mail you your free credit report or email it to you within 5 business days.
Yes, I actually recently had to do that since I moved apartments. So I had to go through Equifax. So I remember the process.
Yeah.
Any other questions from our audience? I know there are a few of you still here. Type them into the Q&A. Just a few more seconds. No. So what we'll be doing, just great seminar. That's love those questions. Great. What we'll be doing, thank you all for attending. This has been recorded, so we will be putting it onto the Elmwood YouTube channel once it's been edited for the beginning and the ending part. Also, we'll be sending all of our registrants a quick survey afterwards to see thoughts and any type of feedback for future OGAA speaker series webinars. But that's on the other side. I'm going to leave it to Janan to sort of wrap this up and do our thank yous. So.
Yeah, thank you so much for everyone for joining us today. It was the first session of many, so looking forward to hearing your feedback, and I hope you were able to take away a few pointers from Suzanne. I'm definitely going to be going over the deck again just to take some more notes. It was all really helpful. So definitely thank you, Suzanne, for running this today.
Thank you very much for having me.
And also along with the survey, we'll be sending out Suzanne's generally said to send out her contact information, is allowing us to do so. So a wonderful resource, very much appreciated. Any comments you can send to ogaa@elmwood.ca or to myself, athompson@elmwood.ca. And looking forward to more of these. But Suzanne, great first speaker series. So thank you so much. Oh, wait a sec. Great seminar. That's it. Thank you so much. And we are going to be ending that right now.
Great. Thanks, everyone.
Thanks, everyone.
All right. Bye.
Bye.